This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on to the present decade and a tour of the commodity markets. Listeners, you'll find the download link for Patrick's chart deck in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, look for the red button that says Looking for the Downloads. Patrick, tour of the commodity markets. What's going on here on page 2 with the S&P?
Well, I just wanted to start with a few charts, just updating the S&P 500 and the dollar, and then we can move on to the commodities. So what I wanted to simply highlight on the S&P 500, and you talked about the 200-day moving average. We're trading right at it. I don't have it on the chart here. What I wanted to highlight was that off of the June low, we are now 60 days and almost 19% or almost 700 S&P points off of the low. And what I thought was really interesting about both the duration and magnitude of this rally is comparing it to the bear market in 2000 to 2003, which is where I have on page 3. And what I wanted to simply highlight here was that, first of all, this is a weekly chart so that I can encompass the entire span of the bear market. But in 2001 and again in 2002, there was these significant bear market rallies. And once a short-term trading low was established, these bear market rallies lasted anywhere from 30 to 60 days. And in these cases, they were over 20% in length, in percentage gains off of their low levels. And I think we're coming to an incredibly important crossroad here on this advance, which is very similar to these types of bear market rallies. We're now going to find out in the coming month as we move into September whether or not this was in fact some sort of a bear market rally or whether or not there's something more bullish underway. And one way or another, this is a level right at that 200-day moving average where we're going to get some very important information over the coming weeks. It'll be really interesting to see how it develops.
Patrick, let's move on to the U.S. dollar index on page 4. Looks like maybe we put in a short-term bottom there, and we're seeing at least a short-term trend reversal. What's happening here?
Yeah, I really just wanted to highlight a couple of things. First of all, in technical analysis, it is common for what were previous highs to act as support and pullbacks, for retracements to be, 50% of the prior rises. This entire pullback over throughout July into this early part of August fit the characteristics of a very natural consolidation or retracement of a prior bull advance. With us seeing today's breakout candles, there's no reason to believe that the prevailing bull trend and the pattern of higher highs and higher lows and all dips being bought has shifted or changed. I don't have the euro chart up here, but the fact that the euro is breaking down below 101, heading right back to parity, is just once again going to come to a really important test. I mean, if the euro doesn't hold parity, I doubt it stops at 99 cents. And so there's really the backdrop of a make it or break it moment, even as the US dollar yen is heading toward 136. We're going to really see whether or not the US dollar gains some traction. But the bigger thought I have on that, Eric, is typically US dollar strength is associated with a risk-off impulse. And it's interesting that the dollar is attempting to break out at a time where the S&P 500 is reaching an important crossroad and many commodities are weak and other things like that. It'll be really interesting to see whether a dollar breakout engages here and whether that spills into the inner markets and starts to drive a risk-off impulse going into Labor Day. With that said, Eric, let's move on to crude oil. And this chart right here, when I snapped it, crude oil was at $90. But we, as we speak here on that September contract, we're already at 91.37. Just it's been a rather quick little rally that's been happening over the last couple hours. To me, this is actually a really important crossroad. As we broke to a lower low just a few trading sessions ago, typically that opens a floodgate. As a lower low is made, it usually creates a feedback mechanism of technicians and chasing trend, stop losses being hit, margin calls being made, and usually it leads to some downdraft. But oil broke temporarily to a lower low, and very quickly is snapping back. Now, the pattern of lower highs and lower lows is very distinct, and by no means is this chart bullish yet. But one of the very key things that I'm going to be watching going into next week is whether we can wipe out the entire last sell-off, which is crude oil makes it all the way back to 95 plus. If we see that it can crack 95, pullbacks are being bought on dip, and the whole chart is turning up, maybe this 2-3 month sell-off in crude oil may be coming to an end. What's your take on it?
Well, I'm certainly watching closely, Patrick. The fact remains that right now what we have is a series of lower highs and lower lows. If we can turn that around, as you say, and get above last week's high at 95 and turn this into a sequence of higher highs and higher lows, that's a whole other story. But that hasn't happened yet. And for now, what has surprised me was, even on that really, really big inventory draw yesterday, it caused an algorithmic panic spike of buying, and it was immediately sold. So there were people who were still skeptical enough of this market that, even trying to recover to the 200-day moving average, they were selling hard into that. So there's at least some of the market that thinks this is not over yet. And at some point, I'm sure the bulls are going to win because we don't have enough energy left to return the economy to normal. But we probably need to get through the recession before that's going to be a factor.
Eric, let's move on to gold. I just wanted to highlight, I agree in many ways with what you were saying in the market wrap at the beginning. I mean, I remain bigger picture bullish gold, but there's no denying lower highs, lower lows in a downtrend with this current rally looking no different than the bear market rally we saw in the S&P 500 and just rolls over. And so really there is no evidence that a bottom is in and that it's all bull from here. But if it was going to turn bullish, Eric, one of the things that would be seen here is that this current sell-off that rolled over shouldn't make lower lows, right? And so as we get to 1750 or even a very deep retest of 1700, we should see the bulls defend the line pretty well and quickly rally it back above 1800. If we started seeing those kind of characteristics into September, then maybe there could be signs of a reversal and bottoming formation, but it's very premature to make any of those conclusions. It'll be all about the way the sell-off looks, and that's what I'll be watching from here.
Well, I agree. It's definitely premature to decide whether this is just a little pullback or if it's a trend reversal and we're headed to lower lows. But I'm going to give it a 50-50 either way. I don't think there's any reason to be too super bullish here. Let's move on to natural gas futures on page 7.
Now, this is where there's a market that is marching to the beat of its own drum. Natural gas continues to make higher highs and higher lows, but really now has worked its way right back to those major highs that it put in through the summer. And as we approach this level, we're about to get that really important tell as to whether or not another bull run may emerge here. If this just cracks those highs on a closing basis, there's every chance that we might see $11 or $12 on the upside of nat gas. Now, have we broken to new highs yet? No, but it's certainly the thing to watch here on nat gas.
I agree, Patrick, and for anyone who missed it, you definitely want to hear Adam Rosenzweig's interview on nat gas a few weeks ago, as he has a very bullish view on where it's headed from here. Let's move on to copper futures on page 8.
So what's interesting is obviously everyone follows copper as Dr. Copper, which is a sign of economic health. And clearly with an economic recession and a slowing economy, that copper demand going down is not abnormal. So we had a very violent drop through June into July. And since here, it's been retracing. I think it mirrors what we're seeing in gold in many ways. Now, obviously, it's a different type of metal, but it was very oversold. It's bounced, but there's really just no evidence that this is anything more than a bear market rally, very similar to what we saw on that other chart. And it would not be a shocker for us to see copper go and retest its lows, establish double bottoms, create basing formations. It's just really hard to make a case that this is going to start bulling in this window of time. With that said, I mean, I still am a commodity bull in the bigger context. It's just these charts just it may be a little bit early in the month of August looking for the next bull markets to start. Though, Eric, when I want to move on and actually to page 9, look at lumber. And now this is where there's been some really ugly bear market price action. And while lumber had two amazing rips in 2021 and 22 that saw prices get up to 13 to 1700 on the upside, we've really seen a very tough 6-month go for lumber as we've gone from 1300 and temporarily traded below 500. What we have is a very interesting little reversal that happened the other week, and it'll be really interesting to see if this starts to show signs that we've hit some sort of a short-term low after such a prolonged sell-off. It'll be really interesting to see whether there's more selling to come or whether this is all really now been realized.
Moving on to wheat futures on page 10, looks like we've retraced most of that premium that came in after the Ukraine war started.
Yeah, this is what made the interview with Lee so interesting, and that's why I felt that we had to put it in. Certainly, there's an argument to be made that the grains are going to be bullish in the decade to come, but this recent pullback in the last couple of months has done some very serious technical damage to any bull trend. With this deep of a pullback underway, there's definitely no sign of a bottom just yet. Now, can we get down to below 700? Or even lower, or when are we going to start seeing this trend shift? That's one of the bigger questions. I really do agree with Lee in many ways and think that there's an opportunity to trade this bullishly, but this chart is pretty ugly right now. What I, though, wanted to just touch on, Eric, was on page 11, I put on the Agricultural Producers Fund, which is the symbol VEGI. And what's interesting is that while many of the grains have been selling off pretty hard and are not far off of their multi-month lows, this bear market rally in equities certainly has spurred quite a reaction in many of those ag names, including the two that Lee mentioned, which was Mosaic and Nutrien. Both of them have had meaningful rallies, which is reflected in this ETF. And really what will be interesting to see is will they all head right back down? Will we see some sort of retesting? And where is the real buying opportunity in this space? I do agree in many ways that this is a great space to be in. But, after this thing has gone from $37 to $44 in a month, it's certainly not my favorite spot from an asymmetry perspective to start buying up here. It'll be interesting to see the way it behaves during pullbacks.
Listeners, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading, Patrick's trading service. Information's on page 12 and 13 of the slide deck or at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.